You hear it everywhere, right? Wall Street this, Wall Street that. But what is it really? Why is it so important, and why does it seem to be at the center of every financial conversation? Wall Street is often portrayed as this mysterious, almost mythical place where fortunes are made and lost. But at its core, it's much simpler than that. Think of Wall Street as a giant marketplace, like our very own Pasar Malam, but instead of hawker food, they're selling pieces of companies. These pieces are called stocks. Just like how you might buy a delicious satay or a refreshing drink at a night market, investors buy stocks. But why do they do this? Companies sell these stocks to raise money, kind of like issuing coupons to open a new stall. When you buy a stock, you're essentially buying a small piece of that company. If the company does well, the value of your stock goes up. It's like buying a coupon for a new food stall and hoping that stall becomes the next big hit. Companies use the money they raise from selling stocks to grow their business. They might open new stores, develop new products, or hire more employees. It's a way for them to get the funds they need without taking on debt. Investors, on the other hand, buy these stocks hoping their value will go up, letting them sell for a profit later. It's a win-win. Companies get money to grow, and investors get a chance to grow their wealth. But it's not just about making money. Owning stocks can also give investors a say in how the company is run. They can vote on important decisions and even attend annual meetings. Wall Street, or the stock market in general, is where these buying and selling transactions happen every single day. It's a bustling hub of activity, with millions of shares changing hands. It's a global hub where millions of investors, from everyday folks like you and me to big-time financial institutions, come together to trade stocks. It's a place where dreams can be realized, but also where risks are taken. It's exciting, fast-paced, and plays a huge role in how businesses get funded and how our economy grows. The stock market is like a barometer for the economy, reflecting the health and confidence of businesses and investors alike. Think of it as the heart that pumps money into businesses, helping them expand and create jobs. Without it, many of the companies we rely on every day wouldn't be able to grow and innovate. So the next time you hear about Wall Street, you'll know it's not just a place but a vital part of our economic system. Let's say you want to open a new kopitiam, right? You have a great idea for a menu, a perfect location in mind, and a vision for the ambiance that will attract customers. But there's one big hurdle: funding. You need money to rent the space, buy equipment, and hire workers. This includes everything from the coffee machines to the tables and chairs, and even the initial stock of ingredients. Instead of taking out a big loan from the bank, which can be risky and come with high interest rates, you can actually sell shares of your kopitiam to the public. This way, you can raise the necessary funds without the burden of debt. Each share represents a small ownership stake in your business. When people buy these shares, they become partial owners of your kopitiam. They invest in your vision and share in your potential success. This process of selling shares for the first time is called an initial public offering, or IPO. It's a significant milestone for any business, marking its transition from a private entity to a public one. Once your kopitiam is listed on the stock market, anyone can buy and sell its shares. This means that your business is now part of a larger financial ecosystem, where its value is determined by market forces. Think of it like carousel, but for company shares. Just as you can buy and sell items on an online marketplace, you can trade shares of companies on the stock market. If your kopitiam is doing well, people will want to buy more shares, driving up the price, just like a popular listing. The more successful your business, the higher the demand for its shares. Conversely, if your business is struggling, the share price might go down. Investors may lose confidence, leading to a decrease in demand for your shares. The stock market is all about supply and demand. The price of a share is influenced by how many people want to buy it versus how many people want to sell it. The more people want a stock, the higher the price will go, and vice versa. It's a dynamic environment where the fortunes of businesses can change rapidly based on market perceptions and real-world performance. So by selling shares, you not only raise the funds you need, but also invite the public to be a part of your business journey. It's a way to share both the risks and rewards of entrepreneurship. And who knows, with the right strategy and a bit of luck, your kopitiam could become the next big thing on the stock market, making both you and your investors very happy. So, who are the key players in this exciting world of stocks? First up, we have the investors. These are the people who buy and sell stocks. Investors come in all shapes and sizes. You have individual investors like you and me putting in our savings for retirement or a new house. Then you have big players like institutional investors managing huge pools of money for pension funds or insurance companies. Next, we have the brokers. They're like the middlemen, connecting buyers and sellers in the stock market. Think of them as property agents for your stocks. You tell them what you want to buy or sell, and they execute the trades on your behalf. With the rise of technology, online brokerage platforms have become super popular, making it easier than ever for anyone to trade stocks from their phones or computers. No more shouting matches on the trading floor. Now, how are stock prices actually determined? It all boils down to, you guessed it, supply and demand. If more people want to buy a particular stock than sell it, the price goes up. If more people are selling, the price goes down. Simple, right? But here's the catch. Many factors influence supply and demand. A company's performance is a big one. If a company announces killer earnings, investors get excited, demand for the stock goes up, and voila, the price follows suit. On the flip side, bad news can send investors running for the hills, causing the price to tank. Imagine trying to keep track of the prices of every single stock in the market. It would be like trying to count every grain of rice in a sack. That's where stock indices come in. They're like benchmarks that track the performance of a group of stocks. Think of them as report cards for the overall market. You've probably heard of the big names, the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. These indices represent the performance of major stock exchanges, giving you a quick snapshot of how the market is doing overall. The Dow Jones Industrial Average tracks 30 large, well-established companies, while the S&P 500 covers a broader range of 500 large-cap stocks. The Nasdaq Composite focuses on technology-heavy companies. Now here's where things get really interesting. Stock prices aren't always driven by logic and reason. Emotions play a huge role, especially in the short term. Fear and greed are like two sides of the same coin in the stock market. When investors get greedy, they get caught up in the hype and buy stocks based on speculation and rumors, driving prices up higher and higher. But when fear takes over, investors panic and sell, sending prices plummeting down. This emotional roller coaster is what causes the stock market to be so volatile, with prices swinging up and down like a monkey on a mango tree. So, you're ready to dive into the exciting world of stock trading? Hold your horses. Before you start buying and selling, remember this golden rule. Do your research. Don't just buy a stock because your friend told you to or you saw it trending on TikTok. That's like buying a durian without checking if it's ripe first. Before investing in any company, take some time to understand what they do, how they make money, and what their future prospects look like. Look at their financial statements, read analyst reports, and follow industry news. The more you know about a company, the better equipped you'll be to make informed investment decisions. Now, there are generally two approaches to playing the stock market: investing and trading. Each has its own unique strategies, benefits, and risks. Understanding these differences can help you make more informed decisions about where to put your money. Investing is like planting a seed and watching it grow into a mighty tree. This approach requires patience and a long-term perspective. Just as a tree doesn't grow overnight, investments take time to mature and yield returns. You buy stocks for the long term, holding them for years or even decades, hoping to benefit from the company's growth over time. This method relies on the belief that the market will generally trend upwards despite short-term fluctuations. Trading, on the other hand, is more like flipping that durian for a quick profit. It's about seizing opportunities in the market's daily or even hourly movements. Traders need to be quick on their feet and ready to make rapid decisions. Traders buy and sell stocks more frequently, trying to capitalize on short-term price fluctuations. This can be thrilling and potentially very profitable, but it also requires a lot of time, attention, and a higher tolerance for risk. Which approach is right for you? The answer isn't straightforward. It depends on various factors, including your financial goals, risk tolerance, and the amount of time you can dedicate to managing your investments. Well, it depends on your risk tolerance, financial goals, and how much time and effort you're willing to put in. If you prefer a more hands-off approach and are willing to wait for your investments to grow, investing might be the way to go. Investing is generally considered less risky, but requires patience and discipline. It's about playing the long game and trusting that your investments will grow over time, much like watching the calm, steady waves of the ocean. Trading can be more exciting and potentially more profitable, but also carries higher risks. It's akin to riding a roller coaster, with its thrilling highs and stomach-churning lows. You need to be prepared for the emotional and financial ups and downs. It's like choosing between chicken rice and chili crab. Both have their own unique flavors and appeal, but your choice depends on your personal preferences and what you're in the mood for at that moment. Both are delicious, but it depends on your taste and what you're in the mood for. Similarly, whether you choose investing or trading, the key is to understand your own financial palette and make choices that align with your goals and lifestyle. So, there you have it, a crash course on the stock market. It's a fascinating world where companies raise capital, investors seek to grow their wealth, and prices fluctuate based on a complex interplay of factors. Remember, the stock market can be a powerful tool for building wealth, but it's important to approach it with caution and a healthy dose of research. Don't be afraid to ask questions, seek advice from financial professionals, and never invest more than you can afford to lose. Happy investing!